Okay, everyone, it's 2 o'clock, so we're going to get started now. I hope you can all hear me. For those of you that don't know me, I'm James Marchant. I'm one of the directors of Sovereign IFA. So good afternoon to you all, and welcome to our first webinar entitled What Does a Coronavirus Crisis Mean for You and Your Investments in 2020 and Beyond? I have some fellow panelists with me today. So my co-director, Mark Hibbett, who some of you know, is with me. And I'm also delighted that we're joined on the panel by David Jones and Tim Wood from Dimensional Fund Advisors. Now, I won't steal David's thunder as he will tell you a little bit more about Dimensional in a minute. But suffice to say that Dimensional are a US-based fund management business which looks after 459 billion pounds worth of investors' money around the globe. So we are delighted that representatives of such a prestigious company can join us on the webinar today. Before we get started, just a little bit of housekeeping. We are expecting that the session will run for about 45 minutes, give or take, but we're not in a rush, so if it goes on longer, that's great. There will be plenty of time for you to ask questions of Mark and I, but also of our guests as well. We've had some pre-meeting questions, which I think will get answered in the presentation. But if they don't, then we can address those at the end. So you can use on your screen, at the bottom of your screen rather, there's a chat button or a Q&A button. I'm not sure which one will work, but you can ask questions in there. Mark will be keeping an eye on those and we will try and scoop some of those up a little bit later on in the session. The second thing to let you know is that we are hopefully recording this webinar and we will be able to send you a link afterwards by email so that you can listen back at your leisure. And one final point before we get cracking, this is our first webinar. Hopefully the technology is working, but please be gentle with us if it's not. And also, we welcome any of your feedback afterwards, whether positive or negative, and constructive suggestions for future sessions that you might like will be welcomed as well. And we'll take all of that on board. So let's move on with today's session. And I just want to set the scene really with a couple of slides just before David speaks. First of all, just to confirm the agenda, so I'm just going to open up with a bit of an introduction, and then David Jones from Dimensional is going to speak to us. He's got a sort of a 25-minute or so presentation to talk through. Then we'll have some Q&A and then we'll close. So why are we here today? Why are we here on this webinar talking today? I don't want to focus hugely on charts and graphs at this stage because we can read into these sort of things what we want, but it's important that we set some context around where we are today. And I've just chosen the FTSE 100 because it's the index that most of you understand and recognise. We hear it on the news, quoted on the news most days. And this just graph you're looking at here just covers the period from last summer through until just a couple of days ago. So what we can see is that the FTSE index was going along nicely. And then we see this sort of sudden drop off midway through February. And we've seen a bit of a recovery. It's been a bit volatile, but we have seen some recovery and things have settled down a little bit over the last couple of weeks. Those of you that follow the markets would have seen things going back up a little bit. But what does that mean in the context of sovereign portfolios? Because I think this is probably what you're more interested in. Very few of you will have all of your money in one market, and very few of you will be invested fully in shares. You will have what we call multi-asset portfolios. So most sovereign clients will have exposure to shares globally, but also things like government bonds, cash, and property. And that will have cushioned you from the worst of the market fall. So typically, I mean, these are sort of rough indications. Typical sovereign clients are currently sat on a approximately 8 to 12% paper loss. And I use that word carefully, paper loss, because there's never a loss until you physically sell something, but a paper loss for 2020 compared to the FTSE 100 index, which is down circa 23% over that same period of time. So I think the point I'd like to make there is that when you watch the news and you see billions wiped off stock markets today, that doesn't mean to say that your investment has been hit in the same way because of this multi-asset approach to investing that we deploy. The other point is that many clients have experienced small positive returns over the last 12 months. Certainly in this last week, 10 days, I've been talking to a number of clients that we're having our annual review. And on reviewing their portfolios, some people are still seeing a small positive return over the last 12 months. It depends where your money's invested and what level of risk. And also, anybody who's been invested for more than 5 years is still holding on to some quite good returns. So I think the point Mark and I would both like to make here is context, really. Don't look at short periods of time. You need to look at what your portfolio has done over much longer periods of time. And in many cases, if you go back 5, 6, 7, 8 years and compare then to where you are today, the majority of our clients would still be in a pretty good position. And I think that's really important for you to bear that in mind. And a little comment I made there at the bottom is the BBC and the Daily Mail aren't very good at telling you the whole story. And they're not, you know, they focus on sensational headlines. But the bigger picture for the majority of you is a lot more positive than what it first appears. So we just wanted to emphasize those viewpoints for you. And just one other quick little chart or graph I thought that you might be interested in looking at before I introduce David. Here's a history. So this is the MSCI World Index. So this is a global stock market index going back from 1970 up until, it covers the period up until January this year. So it doesn't, you don't see the tip off in markets with this particular slide. But what I wanted to show you here is that the event that we're currently going through, this major health crisis, isn't completely unusual. Yes, it's severe. The magnitude of it is severe, and we don't underestimate that. But we've had things like Ebola, Zika, cholera, swine flu, SARS, amongst others. And as you can see from this chart here, in every case, we've come through a crisis caused by some sort of health situation, and we've come out the other side, and markets have continued their upward trend. And I think this graph really does show you nicely the whole concept of long-term investing and why investing over long periods of time is what we constantly talk about as advisors. So there's just a little bit of an introduction for you, a little bit of a scene setting for you. And what I'd like to do now is to introduce you to David Jones, who's going to take the next bit of the session. So David is the head of the UK and Ireland Advisor Group and Vice President of Dimensional Fund Advisors, who are a huge American fund management group. David is based in London. He manages the team of regional directors, which includes Tim Wood, who's with us on the call. And Tim works with us and other advisors around the country. David joined Dimensional in 2009. Having spent the previous 20 years running his own financial planning business in Southwest London. So he's a really good understanding of what it's like on our side of the fence, as well as from a fund manager's perspective. In addition to his day job, David is a keen sportsman. He's a masters rower. He's a keen musician, and you'll see some guitars there over his left shoulder, if you can see him. I don't know if you can see him or not, but anyway, he's a classical guitarist. And David has recently started work on a PhD in finance at Coventry University. So David, I'm going
to... You've muted out, James. Great. So thanks very much, James. I hope everybody can hear me. I'm just going to start sharing my screen now, and hopefully we'll jump into live. Yeah, so good afternoon, James. Thanks for that kind introduction. Yes, there's been a great opportunity over the last few weeks to sit in my office here at home and play a little guitar, you know, in breaks between talking to people and working on presentations, etc. So I'm delighted to join you this afternoon, and thanks very much to James and Mark for the invitation. And my theme really for today is around navigating market volatility. And in that last slide that James showed, you know, we see this long history of markets, the general upward trend, but of course along that timeline experiencing, you know, a good deal of volatility as markets sort of deal with shocks along the way. And I was thinking about a good metaphor, something from my own experience of how you deal with these sort of market situations. And I go to, you know, my sport. Yes, I'm a rower, but I'm also a sailor. And when you're sailing, when you're out at sea, you know, quite often you're having to deal with some pretty difficult conditions. You know, if the storm comes up, you've got some big waves coming in, and you have to deal with the situation. You don't want to panic, and there are a couple of things that you can do that help you calm everything down while you take care of stuff around the boat to make sure that you stay safe. And one of those things is you can put out a sea anchor, and that will mean that, you know, you're stopping your drift backwards. You're kind of stabilizing yourself in the waves a little bit. So yeah, you can put out a sea anchor. And the other thing you can do, we call it heaving to. You can heave to, which means that you can set your sails in such a way that your boat will hold position, and then you can go around the boat and do whatever you need to do to make sure that things are safe. So you've got things that you can do in difficult environments that will help you deal with the situation and not panic. So I was then translating that over to how I think about navigating market volatility, and what are my equivalents to the sea anchor and heaving to. And for me, it really sits around, there's a couple of ideas. One is around having an investment philosophy, and the other is having a sense of the longer term perspective. So if I just sort of start with that idea of philosophy, Dimensional, you know, everything that we do is underpinned by this idea that information is in market prices. So when we look at the way that the market behaves, what is affecting the share price is you've got all the available information that's being acted on by market participants. And whether that's, you know, what's going on with that particular company and what's going on within the environment that might affect the future cash flows for that company, for example, airlines or hospitality businesses, or indeed businesses who are making pharmaceuticals, or for example, Zoom, who provide the technology that we're talking to you today. All of those businesses are going to be affected in various different ways, and their share prices will be affected by what people are thinking about in terms of how are things affecting the ability for that firm to deliver future cash flows. And all of those opinions are aggregated together and reflected back to us in one clear signal, which is the market price. And so when markets get very volatile, people often think, oh, this must be that something's wrong, you know, that the market is broken in some way because it's so volatile. And actually, it just means that markets are functioning exactly as you'd expect them to function when lots of conflicting information is entering the public domain all at once, and we're trying to figure out what it means. And so, no, markets aren't broken. Yes, they are volatile, but they are functioning as you'd expect them to function during these kind of times. And so, you know, for us, that's a clear indication that yes, there's a huge amount of information that we're trying to price. We're trying to figure out what future cash flows are going to mean. But the key takeaway also is at whatever point the market is settling today in terms of any individual share, it does mean that from that point, based on the information that we have today and the price that is struck today, there is a positive expected return. So the shares aren't priced today based on we think they're going to go down tomorrow. All the information that we have is in the price today. So I think that helps us sort of come to terms with a little bit more relaxed when we see, as James was pointing out earlier, that information that you get on the BBC about what's happening with the FTSE on a daily basis, putting it into a bit of perspective. And just to sort of my own sort of personal yardstick here is, if they're ever talking about the FTSE at the end of the news, things are probably okay. If they're ever talking about the FTSE right up front at the beginning of the news, then you know that there's been a pretty big fall that day. They never do it the other way around. If there's been a really big price rise in the FTSE, they never lead with that in the news. So as long as it's at the back of the news, then I feel pretty relaxed. So that's the philosophy. It is really trying to get this your mind around this idea that when markets are volatile, they're still doing their job, and they're settling tonight. It'll be based on a positive expected return tomorrow. Now let's look at the second thing, which is around having this long-term perspective on how markets behave over time, given that there's been any number of crises that we've faced along that period of time. So if I look back to 1970, James used the example of epidemics and pandemics that we might have seen along the way. But here I'm showing a broader picture in terms of the various crises that we faced. So I remember living through the 70s, that wasn't a particularly great time. The winter of discontent, three-day week, power cuts, etc. I suppose in my memory as somebody working in financial services, I've got two particular periods of time that contrast really well, because I'm looking at 2001 to where we had the dot-com crisis, and then 2007-8 when there was the global financial crisis. The difference between those two periods of time, back in 2002, when I was still a financial advisor, I was sort of trying to come to terms with what is going on in markets. We were using discretionary fund managers. We thought these managers really knew what was going on, but when it came to it, they didn't really have any answers. When the market fell off a cliff, they were simply shrugging their shoulders, and they didn't really have the answers. Compared with my experience in 2007-8, by which time I was an advisor, but I'd started using dimensional funds and started really getting to grips with the academic work that underpinned how dimensional think about capital markets and why the funds are managed in the way they are. And it was very much about understanding this idea of the information in prices and how different parts of the market behave in different ways. So in the first period of time, 2002-3, not having an explanation really for what was going on, and very different in 2007-8, where I had much better understanding of the way that the market was working and the way that all of those dynamics would be reflected in market prices, which allowed, firstly, me to sort of be much calmer and relaxed and be a much better resource for my clients going through that period of time, essentially helping them to stay disciplined, to stay in their seat. So as we came out of that period of time, that they enjoyed the rewards that came from staying in their seat. So keeping this long-term perspective, and I'll just share another chart here that gives you more of that perspective, because we don't often see, this contrast between a bull and a bear market as starkly as we're seeing it at the moment. Now, this chart, which only goes up to 2018, in the fullness of time, will fully reflect the bear market that we will experience as a result of this crisis. But the overall experience, if you look at this between the blue shading and the red shading, is that we have overall long periods of time, long periods of positive experience in terms of the way that the market behaves, and I'll speak to more to that a little later on. And then we get these nasty shocks, and they tend to be overall much more short-lived than bull markets. But the experience can be, of course, pretty nasty. The thing is that you're generally never going to know that the bear market is finished until sometime after it's actually been, markets have recovered and things are going back the other way. So it's important to keep that in mind when you're making decisions about investment. So this really points that out in stark terms, which is if you miss, and this is what the chart is showing, the bar on the left-hand side is showing you the performance of the market, in this case, the S&P 500, over the whole period, 1990-2017, and you see an annualized compound return of nearly 10%. We then show what happens if you miss the first best day, the best 5 days, best 15 days, and best 25 days of the market over that period of time. And what it's showing is you don't have to miss that many days before you seriously impact the overall return that you would have had from compared to staying invested through the whole period of time. And in fact, if you miss the best 25 days experience in the market, if you were sat on the sidelines, then your experience is not much better than the cash return. And although we don't have the data yet reflected on slides, some of the best up days in markets happened in March of 2020. Of course, some of the worst down days also happened during that period of time as well. But if you're out, then let's say you bailed out at the bottom when the index went around 5,000, and as we see, the FTSE index is today around 6,000. So very important to keep that discipline. So the perspective that we can then give that is to say, well, if I had timed it in and out of the market, what would be the difference? Would I have had some indication of how I could have been rewarded? And the next two slides I'm going to show you kind of illustrate that point. This chart is showing the return, so looking 1 year, 3 years, and 5 years ahead of what happens after a market high. So you get to a point where a market has achieved a historical high, and then you look forward 1 year from that point, 3 years and 5 years, and see what was the experience. Well, measuring back to 1970, you had this 11.5% look ahead for a 1 year return, 10.9% for 3 years ahead, and 9.5% for the 5 year look ahead. Well, what happens if you then measured from a market decline? So in this case, a decline of more than 10%. Now, looking 1 year ahead from a decline of more than 10%, you do see a higher return in the subsequent 12-month period, which is 13.5% as opposed to 11.5%. But now contrast that with the look ahead for the 3 and the 5, 10.4, 9.7, kind of indistinguishable from what you'd have experienced from the market high. In other words, over those periods of time, you kind of get this, we say, reverting to the long-term average return of the market. So I think of it a little bit like the seismograph that measures an earthquake. You have an earthquake, the seismograph goes off the charts. It's incredibly volatile as you experience those shocks. But then over time, it kind of calms down, and you get this sort of standardized pattern reverting to a sort of a straight line graph. And that tends to be what happens in markets when you stand back, and the further you stand back and experience the long-term return. So I think it's then helpful to think about, in the overall scheme of things, when markets are behaving the way that they behave, is what's really my role? What helps me sort of stay in my seat and maintain perspective? And for me, one of those things is to think about the role of the investor. Now, some years ago, and I think if we were doing this live, I would ask for a show of hands, but I'm just going to make an assumption, and forgive me for the assumption, but I'm going to make the assumption that most of the audience, if not all of you, will be familiar with the TV show Dragon's Den. And in Dragon's Den, you have this program where inventors are coming onto the program, entrepreneurs are coming in, and they're pitching their ideas to the dragons. And the dragons are sitting there, they're venture capitalists, and they're making a decision as to whether they should invest in these ideas. And a lot of people, if you were to ask them, say, you know, what is this program? What's the premise of this program? And they'd say, well, it's about the inventions, isn't it? But I take a different view, because I think this is a fantastic way for us to think about how the cost of capital works and how risk is priced, because there are a few key indications. So first thing, it's always the kiss of death, is if one of the dragons says, please tell me you didn't remortgage your house for this, you know that it's really, really bad. But anyway, let's assume that the dragons are now in, and what are they talking about? They're talking about the amount of money that they need to pay in order to get a share of the company. And depending on how risky they perceive that company to be, it'll affect how much of the business needs to be given up to secure the investment. So I thought this was a really good metaphor for, you know, what is happening in markets on a daily basis, almost second by second, as we're thinking about how things are getting priced. And I wanted to find a proxy for how that might be reflected, not just on that sort of a small scale basis like in Dragon's Den, but on a global scale. And the first time I did this chart, it was back when I was an advisor. So I think I was doing it around 2007, 2008. But I was starting to think about how do we respond to this as investors? And I think the most important thing to think about as an investor is being optimistic. And why would we be optimistic? And it's because we must expect a positive return on the capital that we give to the capital markets. Now, why would that be? And essentially, we're looking at funding all of that human ingenuity and creativity that produces the growth that we see over long periods of time. So I got the data from the US Patent Office, and I mapped it out. So went back to 1970. The data actually goes back to the 1900s, but went back to 1970, and you see this exponential growth in patent applications. So from around about 100,000 in 1970 to over 600,000 in 2014, which was the last year I gathered the data. At some point, I'll go back and look. It is public domain. You can go and check yourself at the US Patent Office. You see this huge growth in patent applications. And I think it's important to sort of remember that these aren't a guy in the shed inventing a widget. These are major corporations with big R&D departments inventing new processes and products, and making sure that they can protect their investment in those. About half of the patents that are applied for get granted. So great, you've got a patent, you've got a fantastic product. What do you then need in order to bring those to market? Well, you need capital. And unless you're a business that's self-funding it, you're going to go to the capital markets to get funding to bring your inventions to market. So I overlaid here the growth in global capital. This is the MSCI World, so it's about as close as you can get to as a proxy for the growth in world equity. And you see this, again, exponential growth in world equity, except that it isn't just a nice, smooth upward line. You go through these periods of shock. So you can see there, particular period like the dot-com, which was 2001-2, and then this very steep shock in 2007, 2008. But even with that, you don't see a corresponding drop in the number of patent applications. You see kind of a leveling off, and then again it's upward march, just as you do with capital markets. So I'm not saying for one moment that the only thing that explains the growth in capital markets is the growth in patent applications. That's a very big stretch, but it's definitely a component. In other words, as we're going through this period of time, there are certainly individual companies and industries and whole sectors that are suffering incredibly badly. There are undoubtedly businesses that will disappear and will not come back. But there are also businesses that are doing incredibly good business. There are also sectors that are thriving through this period of time. There are also going to be whole new solutions to problems that we have that we don't even know exist yet. And new companies will come along to exploit those opportunities to fix things and deliver value, delivering value to the market, but also delivering value to those investors who've put up the capital. And so when I kind of think about what helps me when we get these very volatile situations, is to go to, firstly, my philosophy. Markets work the way they're supposed to work. If they're volatile, it's just the way that they're acting in order to incorporate information, which is arriving second by second. And then to stand back and think about our role as investors and why we should expect a positive return over the long term for letting companies use our capital that comes from our pensions and our ISAs, etc. So, I mean, that's for me how I navigate volatile situations. But I recognize that for a lot of people, the key of where that comes from is by working with a great firm of financial advisors. So, in summary, you have to think about what you can control. So if you've got an investment plan, you've got your asset allocation sorted, you've figured out your cash flow modeling with your advisor, then great. You are actually measuring the thing that you need to focus on most of all. You've got your portfolio, you're measuring the success of that portfolio to deliver the goals that are important to you, and not so much how you're comparing about how's that done versus the FTSE today. You've got a very, very diversified portfolio. So if individual businesses or even sectors are going through a difficult period, you've got other sectors that won't be, that will be producing positive expected returns. So staying in your seat, staying disciplined, controlling costs, doing the most tax efficient things you can do, those are what you'd expect from working with a great firm of financial advisors who can really help you navigate through these periods of time. And I contrast the experience of people who do enjoy those relationships, do have the financial plan in place, do have the right asset allocation to be able to weather the storms, with the experience of those people who just don't. And I saw something from an advisor the other day, and again, we've all tried very hard to encourage people to do financial planning, to encourage them to make provision for their retirement over the years. And he was saying, if you want to know what retirement without proper provision feels like, you're living it right now. You're not able to go out, you can't afford luxuries, you shop only for essentials, and you can't go on holiday. And so I don't think that's true for anybody on this call, because you are working with a great firm of financial advisors. So with that, I'm going to hand back now to James, see if there's anything, any questions that he'd like me to deal with, or Mark, anything that you want me to cover. Otherwise, I'll thank you very much for joining us today.
Yeah, great. Thanks for that, David. That's much appreciated. So I'm just going to share my screen again briefly. Um, find the right thing. Bear with me, everybody. I'm just going to go on to. So we're on to questions now. So Mark, do you want to unmute and focus on some questions if you've got anything there?
Yes, that's fine. Thanks, James. And thanks, David, for your presentation. Yeah, we've got a few questions, so I'll pick them up one by one. I'll answer some of them in part myself and obviously hand that across to other panelists as well. So the first question we have is in from Peter. Peter makes the point, out of every adversity comes seeds of equal or greater benefit. Hopefully you will identify. I think the answer on that is yes, I do identify. I think we all would. I think that would be borne out by David's slide on the US patents, because we would see innovation and some change that will present some opportunity. David, would you have anything to add to that?
Well, I mean, it's exactly that. You know, there's so much work going on in all sorts of different places. You know, if you look at the pharmaceutical business with technology, you know, I think we all accept that our lives are going to be different. But any situation where problems or different situations are being presented for which somebody is going to identify a solution, and we don't necessarily know what that is yet, but when you want to bring that solution to market, the only way that you can do, you know, raising capital to bring those to market, generally speaking, is, you know, that's what public capital markets do. They provide that opportunity. So in a sense, in a very broadly diversified portfolio, you don't have to try and identify those individual opportunities yourself, because the market does it for you. You hold a broad portfolio. As they become eligible investments, you buy them. Obviously, along the way, then some people, you know, they want to find, you know, crowdfunding, for instance, has become incredibly popular way for people to interact more directly with the, you know, these innovations, and that's a very interesting thing, a more recent innovation. But, you know, broad-based, yeah, definitely is you know, trust the long-term return that you get from a broadly diversified market.
Okay, thanks, David. Next question in from an unknown attendee. Do we think there would be a second dip in the markets in the autumn when markets realise the extent of the worldwide recessions? And is it worth considering selling one part of one's portfolio now while markets have recovered slightly, and repurchasing later in the year? Well, I think hopefully you would have seen from the slides that our answer to that, the second part of that question, would be no, on the basis that the first part of the question is completely valid. I think, would there be a second dip? We don't know. There could well be. It will depend on a number of factors. We saw earnings data come out in April that wasn't too bad, but of course that was for the first quarter, which much of it was spent pre the world going into lockdown. I'm sure there'll be some adverse financial announcements coming out, and there may be second waves of the pandemic in countries going forward that will affect things. But we don't know when, where, or to what extent. And I think the slides around missing the most positive days in the market perfectly illustrate why we can't try and time the market.
And Mark, I would agree with that, and the difficulty that you know, dimensional we don't forecast, and sometimes, you know, some things seem obvious, like, well, yes, whether it's October or whether there are always going to be points where there's going to be a dip in the market, and wouldn't it make sense to time out of those? And the difficulty is with market timing is that you have to get it right, not once, but twice, which is the point where you'd re-enter. Like, did you know on the 9th of March, the direction that the market was going to take? And well, we didn't. It was heading downwards. It was looking pretty bad. And lots of people did bail. and maybe wouldn't have made a decision to go back in. So the challenge is not getting it right once or twice, but actually over an investing lifetime, consistently making these decisions to time in and out. And we've had plenty of academics try to investigate the question, because it'd be, I mean, it's awfully tempting, isn't it? If you could find some kind of signaling or system that would say, actually, you could get this right consistently, you'd clearly clean up. But the investigations that academics have done said, unfortunately, there are no clear signals that could tell you to get it right on the way out and on the way in. And nothing over the long period, nothing beats staying invested. So I think the more relevant question then is about having the right asset allocation that allows you to go through those periods of time where what you most want to avoid is you're withdrawing sort of, let's say, living costs. You're living off your equity, and you don't want to be drawing out of a falling asset. And so in that case, if you've got the cash buffer in place that allows you to go through those periods of time where you don't have to draw the required income that you need from the falling asset, which is equity at that particular time, but you've got the cash buffer that allows you to do it. And those are classic, the financial planning asset allocation questions. And, that's the reason that you work with a firm of advisors who help you put all that in place. And actually, probably one of the most important things that you can do when you're thinking about your asset allocation and you're saving for these things is also think about the fire drill for what are you going to do when these things occur. Have you got your flexible spending plan in place so that given any state of the market, what you're going to do ahead of time to respond. And I think that's a great service that financial advisors can help with their clients.
Okay, I think David, that probably answers part of Aidan's question, which runs on from the last one, which is if we have spare cash now, where would you recommend we invest it? James, I'm sure as a fellow planner, you'd agree with me that answer has to be somewhere that is appropriate for you as an individual in terms of your attitude to risk, your capacity for loss, and then also very specific to you in terms of what goals you have. So where you invest that will be dependent on those two things, but also the need for that money, and whether that is future retirement, whether that's income in retirement, whether that's to pay future debts, or to save for children, whatever it may be. James, anything to add on that?
No, I completely agree. I mean, most of our clients have cash buffers built into their plans, and we do that deliberately, and we review it on a regular basis so that we don't leave people too short of cash. So you only invest money that you can afford to invest, taking a longer term view. So whether you feel there's an attractive entry point into the market or not, some may feel a little bit bullish, some may not, but it's what you're doing with that money long term. And if it's money you can invest for the long term, then arguably there's always a good time to invest. It just depends on your perspective, doesn't it, really?
Yeah. Okay, and then as it stands, the only other questions are a trio of questions from Simon. So if I look at the first one, Simon says, talking about multi-assets, government bonds, gilts are also under pressure. With governments having to raise cash on world money markets, how easy or difficult will this be for governments to raise finance post-crisis? I have some thoughts, but David, do you want to kick off with that one?
Well, I think it's clearly going to present a huge amount of challenges to governments to raise money, and I think we're all expecting that there's going to be taxation which will be meeting some of that. But the other thing to remember is and that the market for global bond is an order of magnitude bigger than the market for equity, and people often don't realize just how much activity goes on in global bond markets, not just from governments, but a lot of businesses raising money, and ultimately, in order for that to become attractive as an option, what do people have to do? Is, well, they start having to incentivize you to invest, and so at some point, it always comes out in the price. If they want to raise money, then they have to make it an attractive proposition to raise money compared with other things that you could do. And at one end of the spectrum, that's kind of leaving your money in cash, and at the other end of the spectrum, that's sort of putting your money into much more speculative, maybe equity-based things. So again, it is a big unknown, but there's probably been never a period like it for the questions that are going to be asked of central banks and governments. I've no definitive answer to that question, except to say ultimately it gets reflected in the price.
And I suppose the reality is it would still be a prized asset, and it is still an asset that is not just bought by the wealthy either now in terms of its mainstream pension funds. So there will still be a market there. Yeah.
Yeah, it's there again. There are no orphan assets. At the end of the day, somebody owns it.
Yeah.
Whatever price is struck, and I go back to that point I raised in the presentation, which is today, whatever price a security is priced that settles at today, it is based on it being a positive expected return. If you look at the mechanics of what's going on within the pricing of assets, people are settling. The price today is based upon the future cash flows or the growth of that asset being a positive expected return from this point onwards. Because if we had information today that would say otherwise, well, it would be in the price already. So worth bearing in mind.
Okay. Simon also makes the point that the last bull market has been built off the back of quantitative easing, and that QE has driven asset class rises. What would your view be on that?
We have been asked, I think that question has been asked probably every, it's continued every year for, ever since quantitative easing was introduced. And again, I can't forecast, because you've got to think about how many bullets central governments and central banks have left to fire. I guess at some point you will see some adjustment. I can't say to what extent or when, but it's certainly all of these things are reflected within the dynamics of the market. But again, thinking about the way that the bond market works, there's a huge bond market that goes beyond what governments do. So it's not the only driver of what happens within markets.
Yeah. Okay. And the final question that's come through is, what do the panelists think about the new uncharted territory that income finders are facing? Companies that were thought to provide guaranteed income via dividends have curtailed those. Some companies have maintained. How does your average pensioner investor navigate the current dividend lottery? I mean, my point would be, firstly, as a planner, I'd have to say that for a client requiring income in retirement, I actually don't care whether that income comes in the form of a dividend or capital growth. For me, when I'm doing financial planning for a client, if a client needs 3% yield a year or income to draw down from their pensions and investments, then to me it doesn't matter whether that 3% is made up of pure growth in the share price, pure dividend, or a mixture of the two. Anything to add there, guys?
Well, at Dimensional, we don't manage our funds in terms of delivering. They do throw off an actual income and dividends, but we don't manage them to do that. And we generally subscribe to the view that that you take the total return into account. There's a really interesting article For those of you who follow Warren Buffett, he's just done his first virtual meeting for shareholders, but people will know that that's tends to be every year a very significant event that a lot of people watch to hear the Sage of Omaha talk. I go back a few years, but he did a really nice piece in his annual letter to shareholders on why Berkshire Hathaway doesn't pay dividends. And so I'd sort of refer anybody to that. If anybody wants it, I'll try and dig it out because it's an interesting read to think about why you should think about total return rather than just dividends. So if anybody's interested, Mark, James, I can follow up with you. I'll see if I can dig out the copy and then you could send it on because it's public domain anyway from Berkshire Hathaway. I haven't read it for a few years, but it really helps you get some perspective on not freaking out so much about relying on individual firms and the dividends that they pay.
Great, thanks, David.
Sorry, Mark. Yeah, there was another article. I forget where it was. I was reading only a few days ago, and of course, I think obviously, if you're investor and you're reliant on dividends, then obviously it could be painful to see those dividends stop. So I completely understand it from that point of view, and hence why Simon's asked the question. But I think we mustn't automatically make the assumption that dividends ceasing temporarily is a negative thing in the context of that overall company, because I suspect that some businesses will use that capital to almost restructure their company for the new norm going forward, and actually taking a longer term view, that will be a good outcome for shareholders in the future. So I think you can look at dividend cuts in a negative way, but I think you can make a very positive case for it in the short term as well, in terms of a company redeploying that capital to restructure a business.
Yeah, okay. I think that wraps up the questions for now. James or David, anything to add?
Well, from me, again, just thanking you for the opportunity to join you this afternoon, and it's been a pleasure speaking with you. As I say, if there's anything I can do or anybody on the team can do to support you, or if anybody has any questions that occur to them afterwards that they want to follow up on, we'd be very delighted to help them with those.
Thanks, David.
Yeah, and just the same for me, really. Just thank you for the 40 or so of you that have joined us today. It's our first webinar. We hope you found some benefit from it. If it's posed some questions or maybe hasn't resolved some questions, feel free to come back to Mark and I post webinar on email or on the phone. We're more than delighted to talk to you. And also interested in your feedback, obviously, about the webinar experience and any other subjects that you might like us to cover. Now this wonderful technology, we'd be delighted to run some more of these if it's something that you would like to hear from us. So do give us your feedback on those things as well. As I say, hopefully this is recorded okay, so we'll be able to get this over to you at some point in the next few days, and you can play it back at your leisure. But yeah, thanks again very much for your attendance, and we'll be speaking to you all very soon.
Thanks, everyone.
Thank you.
Thanks, guys.